Top picks with Darren Sissons. He's been our guest on Market Call. He's taken your questions. Top pick number one, Darren, Atlas Copco, ticker symbol ATCO.B on what looks like the Stockholm Stock Exchange.
Yeah, so really with this trade, looking to capture the 10% currency differential and the fact that the stock is down 30% year to date. So this is a 40% discount in Canadian terms. So it's a global leader in vacuum technology, an asset-light business model, so return on equities in the north of the 30s, does lots of tuck-in acquisitions, and we think that this company is going to perform well. You know, it's a global operation, so it has exposure to a few different verticals. One is you get tires changed for winter, industrial pneumatics, semiconductor clean rooms, anything to do with a lot of capital equipment, that's there. So we like it, we own it, we think it's a good value here.
Okay. You mentioned this one in your answer to one of our energy-related questions, part of your European energy exposure, Shell PLC, ticker symbol SHEL in New York.
Yeah, like this is a well-run company. It cut its dividend for the first time since just after the war, during COVID. But now, obviously, because of the ESG pushback against oil, we've seen obviously the supply response to manage against the Russian oil sanctions is problematic. So we're going to see structurally elevated prices. We'll see dividend growth. We'll see buybacks, and we'll see a continued expansion of the renewables assets. But the profit pools for large cap oils are hemorrhaging cash, and they're obviously going to do things with that cash. So I think this is a good place to get in, particularly on the current weakness of oil. I think oil is moving higher, so this is a good entry level.
Darren, is this the same company as Royal Dutch Shell, the name that we have used for many years to describe Shell?
Yeah, so Shell had the name transition when they moved the headquarters out of the Netherlands into the UK, and that was largely to do with a lot of the ESG pushback. They got sued in the Dutch courts, and they just said, right, enough of this nonsense. This is and obviously, as we've discovered, decoupling energy from the global economy is meaningful. In fact, it is what triggered the inflation and ultimately what triggered Jay Powell to raise interest rates significantly as he has. So anyone who thinks that energy is not a key component to the global economy needs to sort of give their head a scratch, because as we've been clearly demonstrated at the pump, energy is a major input, and we have not made the successful transition to energy, to electrons.
To green energy. Walt Disney is top pick number 3, ticker symbol DIS in New York.
Yeah, so this is a company we've owned for a long period of time. Last year, at the all-time high around 170, we cut half of it, and then obviously the stock has retraced as obviously concerns around high growth stocks have come back, and then the association with Twitter through their streaming business. But at these levels, you need to look back sort of the pre-COVID period from 2009 to 2019. Dividend grew at 20% CAGR, and the total return was almost 18% over that 10-year period on an average basis. So, number of catalysts there. We're going to see a recovery as the exit from COVID continues. So we think there's a lot of upside here, and we think this is priced very attractively for entry levels.
Interesting to see Disney down even on a 5-year basis. Over the years, many, many times we have heard portfolio managers say that they like this stock. They think the management is best in class. What happened? Is this a pandemic story where the market has reacted to the sustained closure of the theme parks? Because one of the other parts of the story, one of the other moving parts, of course, is the streaming business, which is doing very well, we hear, against Netflix.
Yeah, so I think one part of it is the people have traded into it during the rediscovery of the streaming element, and the stock obviously performed very well on that. But I think what is happening is we're seeing a lot of blue chip companies being sold off because people are raising cash. When you see the implosions, what we're seeing in the crypto markets, you're seeing the amount of red that people are seeing in their portfolios. Don't misunderstand. There's a lot of people that have a lot of pain in their portfolio. So if you have a lot of pain in your portfolio and you have multiple ones where you've taken big hits, people are raising cash. So they're selling what they can. And so we saw this in 2008. We've seen this before. We know how it goes. So if you want to make money, you've got to buy when things are on sale. This is the kind of franchise you want to own 10, 15 years. So if you can buy it cheaply, go ahead and do it. But bear in mind, these stocks will move up and down. And so we're happy to own it here. We want to buy more. We already own some.
How would you compare this one to Netflix, another a big story on the markets this year after it reported some disappointing subscriber numbers? The bottom fell out on shares of Netflix.
Well, I think the issue for Netflix, by and large, is that people aren't watching TV now. They actually got alternatives to do. You want to go out to a restaurant, you can. You want to travel, like for example, I have travel booked for this year. I'm going to Europe, and I'd like to go home to New Zealand and see my family as well. So people have alternatives, and then perhaps sitting through the latest version of Peaky Blinders, like as great as it is, like. Quite frankly, if I can go out and do something else, I go play sport, go to the gym, go swimming, like. That's what the alternative is. So, the streaming services are going to be there, but they're going to be repriced lower as demand falls off. People are cutting back. It's like so that business naturally has declined, and it will continue. But Disney, that's only one portion of that's business. And so, would I own a Netflix versus a Disney? I don't even think the answer is the same, because you've got hard to replicate high quality assets with different franchises versus a streaming service. And Disney already has its own content anyway. So it's a completely different animal.
Do you see M&A in Disney's future at all? Over the years, it has been a significant acquirer of businesses like the ABC television network and so on, but it seems to me it's been a while since we've seen Disney make a major acquisition.
I think what we're going to see, and I think this would be a broad general comment, those companies that have good balance sheets, that have proven management capabilities, the ability to integrate, I think we're going to see a lot of tuck-in acquisitions. I think it's going to be very difficult to go to markets and do very large, sizable, transformative acquisitions. So I would say most companies are going to go the smaller tuck-in acquisitions. So, for example, if Disney can pick up a nice adjacent business, then that might be interesting. For example, here in Canada, pick up Canada's Wonderland, just tuck that into the franchise, great. But do I expect companies to do a lot of acquisitions in a rising interest rate environment? I don't know if I would. I think that's base case. For example, look at the two Canadian banks, TD and BMO, both done acquisitions. It's hit the stock, right? So you sort of step back and say, be practical, be conservative, know what you own. Don't make rash decisions. And I think that's probably the takeaway from most management teams right now that they're getting from their board of directors.
Darren,